So now that you're making money, or you be making money, you got to figure out where you're going to put it. And there's three buckets that you put your money into, and it's tax now, tax later, or tax advantage. So go ahead and take a look and put this to use. It's going to change your life.
Okay, so now we're starting over again. I've had a lot of people ask me some questions about tax now, tax later, and tax advantage. So today we're going to talk about tax now versus tax later versus tax advantage. Okay, underline each of those. When you put your money somewhere, it goes into one of these three buckets. Okay, so these buckets are tax now, tax later, tax advantage. Ludus is that as you get your paycheck, your money goes somewhere. Bucket 1, bucket 2, bucket 3. Bucket 4, there isn't one. So let's go see, where does your money go? Let's take a look at the following treatment of the different type of investment accounts. So tax now, we're going to have things like your checking account, your savings account, CDs, certificates of deposit, stocks, mutual funds. Okay, when you take your money and you put them into one of these different types of financial instruments, what you end up having is you're going to get a 1099-I, right? So for checking, your checking account, your savings account, your CDs, that all is at a bank. Your stocks is if you have a stock account with a broker somewhere, and every year they're going to give you a 1099. And then mutual funds, that's just a type of stock. It's just spread out over mutual funds. And even if you buy or sell those, you still may incur some taxable event, because they trade those in and out of the stock, and that would trigger a point for you to get a 1099. The tax later is 401k, 403b, IRA, SEP IRA, annuities, pension. Okay, 401, these are all retirement planning strategies. These are where you take your money, you put them in to these accounts, and then you can take that money off the top as a non-taxable money. Of course, this means that when you do retire or you do take them and use them, you will incur a taxable event in your life. And that could be whenever you touch it. Usually it's meant for retirement. If you pull them out early, many times mostly you're going to have penalties on top of that also. So your 401k is going to be what most companies have for a 401k plan. That prior to that, they had pensions. Pensions are pretty much gone. 403b is a school and things like that. Then we have IRAs. So if you put most in your 401k, then you can go ahead and start to fill out your IRAs, SEP IRAs. So that's if you have a business, they don't have 401ks. So what you do is you end up doing a SEP IRA. Also annuities, these are financial instruments where it's a contract between you and a party, typically an insurance company, and you put an amount of money in there and you get annuities in there. And then when you touch that money, you get a taxable event. And then, of course, as I said earlier, pension plans. Now let's take a look at tax advantage. Roth IRA, 529, college savings, municipal bonds, health savings, which is HSA, life insurance, and long-term care. right? Roth IRA is going to be, Roth is after an individual that was in the government, Senator, Roth, and he put together an Roth IRA where a person can go ahead and put money after taxes into IRA up to a certain amount. Therefore, once they've done that, after tax money goes in there, you never have to pay taxes when you pull it out. 529 college savings plan is an opportunity for you as a parent or somebody to put your money into an account used for college savings. And then when that money gets pulled out after it's been invested, you're going to have no taxable event. Municipal bonds, those are government. Health savings account, a lot of people have a health savings account because they may have known expenses medically each year, and they're allowed to put that amount in there. If they use it or lose it, that's kind of the risk. They don't use it, they lose it. And then you have life insurance, which is whole life, term life. When the benefit is paid out as a non-taxable event. And then long-term care, that is where if you go into you have a contract where you put into an account money for long-term care, and that money doesn't get paid when it gets paid out. A lot of times now with life insurance, these were separate issues. Life insurance has riders in them which have long-term care riders. So these here are all of the ways that someone can put their money into one of these three buckets: tax now, tax later, or tax advantage, so that they can build a good portfolio for when they retire. Probably the biggest issue that people have is most of their buckets, they probably have 80–90% of all their money into this tax now location. A few people have a little bit in the tax later and almost nothing in tax advantage. And so what we really want to do is we want to get all of those buckets mostly even. A lot of people, they put their money into CDs as a savings. CDs don't pay you anything, maybe 1%, 2%, 3%. And you got to take a look at the issue with companies, with banks that, and inflation, that it doesn't even cover inflation. And this is an old way of doing things. Now you have these other opportunities here. And this is the way the wealthy parse their money out into these different buckets so they can put themselves in a position where they can be financially free when they retire. And all of these three things are something you need to learn to become financially educated. And most people do not know or understand this. There's a lot of misinformation about life insurance. One of the things about life insurance that the wealthy use is that they go ahead and they put that information in as or they put into life insurance so that they can pass their information on to their heirs. Okay, so that's something we all can look at, and that's one of the things we have to work with. So I wish you all a good day. Stay tuned for more.